Hey everyone, welcome back to Getting Your Shit Together, where we tackle all things mortgages, finance related, and everything else that keeps you up at night. I am Neil, and as always, I'm joined by my co host Jerome.
Hey everyone. Today, we're diving into a topic that's near and dear to our senior listeners and people of a demographic that have aging parents. Um, we could call them seasoned homeowners, if you will. It's called a reverse mortgage, the topic. And no, it's not some kind of time travel device that takes you back to your youth, although I'm sure many would love that option.
Yeah, I'm sure. But hey, a reverse mortgage can still be a powerful tool if used right. Think of it as a way to make your house pay you for a change. So today, we will break down the pros, the cons, and everything in between. And don't worry, we will make it as painless as possible. All right, let's get started with the basics. A reverse mortgage is essentially a loan secured by your home. But unlike your regular mortgage, where you pay the bank every month, with a reverse mortgage, the bank pays you. Well, until you sell, move out, or kick the bucket. It's like monopoly money, but this time it's real.
Exactly. It's specifically designed for homeowners who are 55 years and older and have significant equity in their homes. So if you're sitting on a house worth $500,000 and still eating canned beans for dinner because your retirement savings have gone poof, something like this might be worth looking into.
Oh, and no monthly payments. You heard that right. Zero payments. It's like a unicorn in the world of loans. But remember, just because you're not making payments doesn't mean the interest fairy isn't adding to your tab.
That is so true. So why would anybody go for this? Simple. Cash flow. If you're tired of stretching your pension like it's a piece of gum, a reverse mortgage can be a way to access the equity in your home in various forms. You can get it in lump sums. You can actually get it in monthly payments where it comes to you monthly, or you can even get it as a line of credit in some situations.
Yep, it's basically your house's way of saying, hey, you have been paying the bills all these years, and now it's my turn to return the favor. You can use the money to supplement your retirement income, pay off your debts, fund home renovations, or even gift your grandkids that down payment that they have been hinting at during every family dinner.
Yeah, and if you're feeling adventurous, you could even fund that dream vacation. Take the world trip. I mean, after all, why not sip margaritas on a beach while your house takes care of the bills for a change?
But hold on for a second, because there is always a catch, right? Let's talk about the not so glamorous side of reverse mortgages. First off, interest. Just because you're not paying it doesn't mean it's not adding up. It's like that treadmill you bought with good intentions, but never use it. It's sitting there, accumulating dust and guilt.
And don't forget the fees. There are some upfront fees for legal advice, appraisals, and closing costs that can reduce the amount that you actually get by a little bit. So, before you start planning that dream yacht purchase, remember the bank takes its slice of the pie first.
And if you're thinking about leaving your house as an inheritance, a reverse mortgage might complicate things. The loan gets repaid when you sell or pass away, which means your heirs end up selling the house to settle the debt. So, if you are hoping to leave a golden nest egg, you might just be handing them a golden bill.
So, this is a lot of information. So, what exactly is a reverse mortgage for? Well, it's not for everyone, kind of like we stated at the beginning. If you've got other sources of income or assets that you can tap into, this could be overkill. But if your home is your biggest asset and you're in need of some cash flow, this could be a game changer.
And let's not forget, Canada is facing a retirement readiness gap. According to Deloitte, 55% of near retirees might have to make lifestyle compromises just to get by. And that figure is expected to grow in coming years. That's over 1 million households. So, reverse mortgage is increasingly becoming a lifeline for those who are house rich but cash poor.
Right. And let's talk real right here. If you have to choose between accessing your home equity or eating instant noodles 3 times a day for the next 3 years, it's probably time to be a little bit creative. But do your homework, because once you sign up, there's no hitting the undo button. At least it may not be that easy to undo.
So, we got some listener questions. Sarah from Mississauga asks, can she take out a reverse mortgage to help her son with his down payment? Well, the short answer is yes. But be prepared to see your home equity shrink faster than a cheap t-shirt in the wash.
Yeah, it's so true. They seem to be getting smaller these days. And Bill from Scarborough wonders, if I sell my house, do I still owe the reverse mortgage? Yes, Bill, you do. It's like the ultimate IOU. When you sell, that's when the bank comes knocking. So don't forget to factor that into your plans.
All right, that's all we got for today. Remember, a reverse mortgage can be a fantastic tool, but it is not a free ride. Think of it as an investment in your own comfort and lifestyle. Just make sure it's the right one for you.
That's right. And hey, if you're thinking about taking the plunge and want to know more, give us a shout. We promise to help you figure it out without any of that boring financial jargon.
That's right. And until next time, keep getting your shit together. Stay smart, stay savvy, and most importantly, stay in control of your financial future. Hello, and welcome back to another episode of Getting Your Shit Together. I am Neil Joseph, here with my co-host Jerome. Today we are going to dive into a topic that can be a lifesaver, a financial lifesaver for some, but might seem intimidating to others. And the topic is private mortgages.
Well, you got it, Neil. Private mortgages aren't the first option most people think about when it comes to borrowing. But there are situations where they could be exactly what a borrower needs. We'll break down why someone might consider a private mortgage, what to watch out for, and when it can be a smart, short-term solution.
And let's be clear, we are not here to sell you on private mortgages, but rather our intention is to help you understand when they can make sense. And just a heads up, we are talking about real numbers and actual experiences, including a recent file that Jerome worked upon that needed to be closed quite quickly. So let's get started. So Jerome, let's start with the basics. What exactly is a private mortgage? And why would someone even consider it?
Obviously, it's the most important question. So a private mortgage is a loan funded by a private lender rather than a traditional bank or financial institution. These are usually short-term loans and often ranging from 6 months to just a few years, with interest rates that can be a little bit higher in the 7 to 12% range today, depending on the file and the documentation provided.
That's quite a bit higher than what most people are used to seeing with conventional mortgages. What is the reason for these high rates and fees?
Good question. The higher rates reflect the additional risk that the private lender is taking on. Unlike traditional lenders, private lenders tend to be a little bit more flexible with their criteria. They don't just look at income and credit scores. More often, the house is the primary feature and security of the mortgage. So if you have a unique financial situation or need to close quickly on a property, a private lender can be a viable option.
Okay, so let's get into some scenarios where a private mortgage might be the right choice. Jerome, you have recently worked on a case that was pretty time sensitive, isn't it?
Yes, exactly. It, it was a new build, and the borrower had to close within 10 days. Traditional lenders were approached, couldn't complete the process within that time frame. So we turned to a private lender who could move much quicker. The private mortgage came in at an interest rate of 11.49% for just a 6-month term. It had a 1.5% lender fee and a broker fee and some legal costs.
Okay, so the borrower ended up paying quite a bit more than they would have with a conventional lender. But it sounds like there were no other options if they wanted to close on time.
That's right. The borrower was at risk of being sued and losing the property if they didn't close. In this case, the higher costs were worth it to avoid the legal trouble and secure the home and not lose their initial deposit either.
Makes sense. Okay, so now let's talk about the cost involved with private mortgages. You mentioned the higher interest rate, Jerome, but what about other fees and what should the borrowers be aware of, generally speaking?
So, in addition to the higher interest rate, you'll typically see a lender fee and broker fees because, under normal circumstances, we, like Neil and I as brokers, we're paid by the lender. But in some cases where it's private, they don't pay us. So then we have to charge a fee for our services. And that can range anywhere from 1 to 3% of the loan amount, not just for the broker fee, but for both the lender and broker fee. Then you're also going to have legal fees because you still need a lawyer to finalize the mortgage. In some cases, you might also face additional appraisal fees, administrative costs such as title, insurance, and just simple administrative costs from the lender.
So it seems like the costs can really add up. That's why you need to think about the long-term impact, right?
100%. Private mortgages are not meant to be a long-term solution. They're for specific situations where you need that short-term access to funds. That's why having an exit strategy is essential.
Jerome, when you say exit strategy, what exactly do you mean? What should the borrowers be prepared for?
Well, an exit strategy is the plan that you have for paying off the private mortgage and transitioning to a more conventional form of financing, if that's even the case. This could mean refinancing with a traditional lender once your situation has improved, or even selling the property if that makes more sense financially.
Okay, so a borrower should never just take out a private mortgage without knowing how exactly they will get out of it, right?
Exactly. And you really need to be realistic about how long you'll need the funds for and make sure that you have a good concrete plan to either repay the private mortgage or refinance out of it. Most private lenders will require you to outline your exit strategy even before approving the loan.
It's a great point, Jerome. So, and again, as mortgage brokers, we are also supposed to look at what the exit plan of the borrowers are. We definitely do not want to put borrowers into a situation that they would find difficult to get out of.
No. And just talking about them all together, like one major benefit of a private mortgage is the speed at which they can happen. Private lenders can often approve a file and fund a mortgage way faster than a traditional lender because they don't have as much paperwork to go through. This can make all the difference in a competitive market or if you need to close quickly, like in the case that I mentioned earlier.
And sometimes the peace of mind that comes with knowing that the deal will go through is worth the extra cost, right?
Definitely, definitely. Easing anxiety or avoiding legal trouble by securing the funds when you need them is a really big deal. But again, it's not something that you should just simply use as a go to option. It's a tool for specific situations.
Okay, so Jerome, let's go back to that case you handled recently. Can you walk us through in a bit more of detail?
Sure. So the borrower was purchasing a new build. He signed the agreement way back in 2022. So it's not like it was really necessary for it to be quick, but he sent the request into his own bank for financing a few months ago. Unfortunately, his bank took some time responding to him, and he's a busy contractor, so he didn't really pay too much attention to the amount of time that it was taking his bank. And then his bank ended up coming back and telling him about 2 to 2.5 weeks before closing that they weren't going to be able to accommodate his request for financing.
Mhm.
So when we got the file, we submitted to a couple of traditional style lenders. And again, with a tight timeline, they also said that it wasn't going to happen. So we engaged the services of a private lender, and they were able to approve the deal, as mentioned before, at 11.49% interest with a 1.5 lender fee for 6 months. Our intention for this client is to get them into more traditional financing within this next 6-month period.
Okay.
So there were significant upfront costs. However, it did allow him to close on time and without any legal other ramifications.
So, Jerome, what advice would you give someone who's considering a private mortgage? How do they know if that's the right move?
So the first thing I would say is you need to consider whether your need is truly short-term and urgent. And if it is, then a private mortgage could be a solution. Next, you need to evaluate whether you have a realistic exit strategy, like refinancing, or are you selling the home? Or is there another plan to repay the loan? In some cases where you say, I'm going to sell the home, that might mean that you're going to put it on the market, but the way the markets are today, it could sit for a little bit longer than you anticipate. So you need to ensure you have enough money to be able to carry. So finally, make sure that you understand those costs involved and how they could impact your overall financial situation.
Okay. So it's about weighing the pros and the cons and making sure the benefits outweigh the risk.
Exactly. And whatever you do, don't be afraid to seek professional advice. A mortgage broker can help you navigate the options and ensure that a private mortgage is used effectively as a short term tool rather than a long term burden.
To wrap up, private mortgages can be a useful short term solution in specific situations, especially when traditional financing isn't an option. But they come with higher costs and risk that need to be carefully managed.
Yeah, so if you're considering a private mortgage, make sure you have a clear exit strategy and understand all of those associated costs that we spoke of. It's not something to be used lightly, but with the right approach, it can solve a very pressing problem.
Exactly. So, thanks for tuning in to Getting Your Shit Together. If you have any questions or want to learn more about private mortgages, reach out to us. And don't forget to subscribe for more episodes on navigating the world of mortgages.
Catch you next time. Stay informed, stay prepared, and as always, keep getting your shit together.